Welcome back to Old Men, New Money. I'm Douglas Borthwick, and today we're covering what I think is the most interesting treasury company model, Sol Strategies, ticker STKE. We've covered Strategy, the Bitcoin pioneer that proved the model works. We've covered Bitmine, Tom Lee's aggressive bet in Ethereum supercycle. Both are pure accumulation plays. Buy the asset, hold the asset, hope it appreciates. Sol Strategies is different. They're accumulating Solana tokens, yes, but they're also running the infrastructure, operating validators, earning fees from institutional clients, building a recurring revenue business on top of the treasury model. This is Treasury Company 3.0. And full disclosure, I'm deeply interested in this company, and I'm also an investor. Now, here's your 30-second version. Sol Strategies is the first Solana Treasury company to list on NASDAQ. They hold approximately 523,000 Sol tokens worth about $105 million. But unlike Strategy or Bitmine, they also operate validator infrastructure on Solana. They're the staking provider for ARK Invest, 3iQ, VanEck, and other major institutions. They manage over 3.6 million Sol staked across their validators, but 88% of that belongs to clients paying them fees. They earn 7 to 9% yield on all staked Sol, and they can purchase locked Sol from the Solana Foundation at a 15% discount to market prices. This is infrastructure revenue, plus treasury appreciation, plus staking yield, the most diversified treasury company model. We're at this point where treasury companies are maturing beyond simple accumulation. Strategy proved that you can use capital markets to accumulate Bitcoin. Bitmine showed you can do the same with Ethereum. Both are essentially one-trick ponies. Hold the asset, hope it appreciates, maybe earn some staking yield. Sol Strategies is building something more complex and potentially more sustainable. They're earning validator fees whether Sol goes up or down. They're providing infrastructure services that institutions need. They're positioned for the Solana ETF wave that's likely coming soon. And they're doing this on Solana, which I believe is a superior high-throughput blockchain for institutional applications. Galaxy Digital chose Solana for equity tokenization. That wasn't random. That was a recognition of Solana's performance advantages. So Sol Strategies is betting on the right infrastructure while also building an actual business beyond just holding tokens. Sol Strategies became the first Solana Treasury company to list on NASDAQ in September of 2025, ticker STKE in the US and HODL in Canada. Unlike Strategy and Bitmine, which were existing public companies that pivoted, Sol Strategies was purpose-built for this model from the start. They understood that Solana's technical architecture, specifically its proof-of-stake design and validator economics, enabled a different kind of business. You see, Bitcoin can't be staked. It's proof of work. You mine it or you buy it, no middle ground. And that's why Strategy is purely an accumulation play. Ethereum can be staked, which is why Bitmine earns yield. But Ethereum staking is relatively new, the validator ecosystem is still developing, and institutions haven't fully embraced staking as a service yet. Solana was designed from day one with staking as core functionality. The validator ecosystem is mature, the economics are well understood, and critically, institutions need validators to participate in the network, but don't want to run the infrastructure themselves. And Sol Strategies saw that gap and built a business around it. Let me explain how this actually works because this is the key differentiator. Solana is a proof-of-stake blockchain. That means instead of miners competing to solve puzzles like Bitcoin, validators stake Sol tokens to secure the network and process transactions. Validators earn rewards for doing this work, currently allowing around 7 to 9% annually. Now, running a validator is technically complex. You need high-performance servers, 99+% uptime, security protocols, monitoring systems, technical expertise. Most institutions don't want to deal with this. Enter staking as a service. You own Sol tokens. You delegate them to a professional validator like Sol Strategies. They run the infrastructure. You earn the staking rewards minus a small fee to the validator. Sol Strategies operates multiple high-performance validators on Solana. And as of October of 2025, they have over 3.6 million Sol staked across their validator infrastructure. And here's the critical part. Only 12% of that 3.6 million Sol belongs to Sol Strategies. The other 88%, over 3 million SOL, belongs to institutional clients who are paying Sol Strategies to stake it for them. Who are these clients? This is where it gets interesting. ARK Invest, Cathie Wood's ARK Digital Asset Revolutions Fund, selected Sol Strategies as their exclusive Solana staking provider. That's a major institutional endorsement. 3iQ, this is a large Canadian digital asset manager. They proposed a Solana ETF to Canadian regulators. Sol Strategies is their staking provider. When that ETF launches, all the SOL in it will be staked through Sol Strategies validators. VanEck, they've named Sol Strategies as a validator partner. VanEck is a major ETF issuer. If they launch a US Solana ETF, Sol Strategies could be the staking provider. Solana Mobile, Sol Strategies runs validators for the Seeker phone. That's Solana's crypto-native smartphone. BitCo, DigitalX, Tetra Trust, all institutional-grade custody and asset management firms using Sol Strategies for staking. Their validator infrastructure serves over 8,800 unique wallets. They maintain 99.995% uptime. They're generating peak APY of 8.59%, which is above network average. This is real business, real clients, real revenue. Whether Sol is at $150 or $50, Sol Strategies is earning fees on over 3 million Sol in client delegations. Let's break down how Sol Strategies actually makes money because it's more complex than Strategy or Bitmine. Revenue stream 1 is staking yield on their own treasury. They hold 523,000 Sol. At 7 to 9% yield, that's 37,000 to 47,000 Sol per year. At current prices, around $200 per Sol, that's $7.5 to $9.5 million in annual yield. Revenue stream 2 is validator fees. They charge a small percentage on the 3 million plus Sol delegated to them. The exact fee structure varies by client, but industry standard is 5 to 10% of staking rewards. So if clients earn 7 to 9%, Sol Strategies keeps 0.35 to 0.9% as fees. On 3 million Sol, that's 10,500 to 27,000 Sol annually, another $2 to $5 million in revenue. Revenue stream 3 is the Solana Foundation discount. This is huge. Sol Strategies has an arrangement to purchase locked Sol directly from the Solana Foundation at a 15% discount to market prices. 15% instant discount. Let that sink in. In October, they bought approximately 79,000 locked Sol using this mechanism. The tokens lock for 12 months, but here's the key. They can stake them immediately. So they get the 15% discount, plus they start earning 7 to 9% yield from day one, plus they benefit from any Sol price appreciation over the 12-month lock period. That's a triple advantage: discount, yield, price appreciation. Compare this to Strategy or Bitmine. Neither gets a discount on their asset purchases, neither has meaningful revenue beyond asset appreciation and maybe staking yield. Sol Strategies has 3 distinct revenue streams, and 2 of them exist regardless of Sol price movements. Now let me dig deeper into validator economics because this is important to understand. Validators in Solana earn 2 types of reward: inflation rewards from new Sol issuance and transaction fees from network activity. Combined, this currently yields about 7 to 9% annually. But running a validator costs money. You need specialized hardware, high bandwidth internet, security systems, technical staff, uptime monitoring. Sol Strategies has built infrastructure to run validators efficiently at scale. Their 99.995% uptime is critical. If a validator is offline, it doesn't earn rewards. Worse, if it's offline when it's supposed to validate blocks, it could get slashed, meaning it loses staked Sol as a penalty. Professional validators like Sol Strategies maintain uptime through redundant systems and monitoring. Their peak APY of 8.59% being above network average tells you they're operating efficiently. They're not just participating, they're outperforming. This operational excellence matters when you're servicing institutional clients. ARK Invest can't have their Sol staked with a validator that goes offline or underperforms. Sol Strategies' track record is why they win institutional business. This 15% discount relationship with the Solana Foundation is extraordinary, and let me explain why. The Solana Foundation holds significant Sol in its treasury for ecosystem development, grants, and network growth. Some of this Sol is locked and released on vesting schedules. Rather than have all of this Sol sit unused, The foundation offers institutions the opportunity to purchase locked SOL at a discount. The discount compensates for the lack of liquidity during the lock period. SOL Strategies negotiated access to this program. They can buy locked SOL at 15% below market price. The tokens lock for 12 months, but they can immediately stake them, earning 7 to 9% yield. Let's do the math. Buy locked SOL at 15% discount. Stake it for 12 months, earning, say, 8% yield. If SOL price is flat, you've made 15% discount plus 8% yield. That's 23% return. If SOL appreciates 10% during the year, you've made 33%. Now compare that to strategy. They buy Bitcoin at full market price, no discount, no yield. They're purely betting on appreciation and their financial engineering to increase Bitcoin per share. The Solana Foundation discount is a structural advantage that compounds over time. If SOL Strategies can keep accessing this program, they can accumulate SOL faster and cheaper than any competitor. And here's why I think SOL Strategies' model is superior to pure accumulation. They're building infrastructure that has value independent of token price. Think about it. If SOL goes to $500, great, their treasury appreciates. But if SOL goes to $50, they're still earning validator fees from ARK Invest. They're still providing staking services to 3IQ. They're still running infrastructure for 8,800 wallets. The validator business has moat. You can't just spin up professional validators overnight. You need track record, technical expertise, uptime history, institutional relationships. SOL Strategies has built all of that. Compare this to Strategy or Bitmine. If Bitcoin or Ethereum crashes and stays down for years, those companies have no revenue. They're just hoping for recovery. SOL Strategies is generating cash flow throughout any cycle. This is infrastructure revenue, and infrastructure revenue is more valuable and sustainable than pure asset appreciation bets. Now, obviously SOL Strategies only works if Solana itself succeeds, so let me explain why I believe Solana is the right horse to bet on. Solana processes thousands of transactions per second. Ethereum does 15 to 30. That's orders of magnitude difference. When Galaxy Digital tokenized their public equity, they chose Solana specifically because they needed that throughput. Solana has sub-second finality. Transactions confirm in 400 milliseconds. And with the upcoming Alpenglow upgrade, that drops to 150 milliseconds. That's faster than a Visa card swipe. Ethereum takes 12 to 15 minutes. Solana's transaction costs are a fraction of a cent. Ethereum fees range from $1 to $20 depending on congestion. For high-frequency applications, consumer apps, microtransactions, Solana is the only option. The developer ecosystem is migrating to Solana. For the first time, Solana added more new developers than Ethereum in 2024. 7,625 new developers versus Ethereum's 6,456. Usage metrics supports this. Solana processes 64 million daily transactions. Ethereum processes 1.2 million. That's 50 times more actual usage for stablecoin transactions daily, not speculation. Actual economic activity, payments, remittances, commerce. And the data is overwhelming. For high-throughput applications that need speed and low cost, Solana is winning. And SOL Strategies is betting on that infrastructure becoming critical to finance, and they're positioning themselves as the institutional on-ramp through validator services. Here's a near-term catalyst that could be massive: Solana ETFs. 3IQ's already proposed a Solana ETF in Canada. SOL Strategies is their staking provider. When that launches, every dollar that flows into the ETF buys SOL. It gets staked through SOL Strategies validators. VanEck and other issuers are likely preparing U.S. Solana ETF applications. The SEC's already approved Ethereum ETF. Solana's next, so when those launch, ETF issuers will need staking providers. SOL Strategies is positioning to capture that institutional staking flow. It's like being the custodian for all the ETFs. You earn fees and all that delegated SOL regardless of market conditions. This could be a structural growth driver that neither Strategy nor Bitmine has an equivalent for. Bitcoin can't be staked, so no validator revenue. Ethereum staking through ETFs is still developing, and Bitmine isn't positioned as a service provider. SOL Strategies is building the infrastructure that ETFs will need, and that's strategic positioning. Let me give you the numbers. SOL Strategies holds approximately 523,000 SOL, worth about $105 million at current prices. They're the smallest of the three treasury companies by treasury size. But they manage over 3.6 million sols staked across their Validator infrastructure. 88% of that is client sol generating fees. They maintain 99.995% uptime. That's world-class operational performance. Peak APY on staking is 8.59%, above network average of 7 to 8%. The 15% discount on Solana Foundation purchases is unique. Neither Strategy nor Bitmine has equivalent arrangements. They serve over 8,800 unique wallets. ARK Invest, 3IQ, VanEck, BitGo, and major institutional clients. But let's talk about the risks, because this model has unique challenges. Solana technical risk. If Solana has network outages or technical failures, the entire thesis breaks. Solana had issues in 2021 and 2022. They since hardened the network, but it's not impossible for problems to recur. Execution risk on validator operations. Running validators at scale is complex. Security breaches, downtime, slashing events, any operational failures could lose client trust and damage the business. Competition from other validators. They are not the only Solana validator. If competitors offer better price or lower fees, clients could move their delegations. Solana price risk. While they have revenue beyond price appreciation, their treasury is still denominated in SOL. If SOL crashes, the treasury value crashes. Regulatory risk around staking services. If regulators decide staking services need different licenses or impose restrictions, that could disrupt the business model. Scaling challenges. As they grow, maintaining 99.995% uptime becomes harder. Any degradation in service quality could cost institutional clients. The Solana Foundation relationship. If the 15% discount program ends or terms change, that advantage disappears. Smaller size. At $105 million treasury, they're tiny compared to Strategy's $47 billion or Bitmine's $12.9 billion. Liquidity and scale matter. These are real risks, and this is the most operationally complex of the three models. But let me explain why, despite the risks, I think Sol Strategies has the best long-term model. Multiple revenue streams, staking yield on their treasury, validator fees from clients, purchase discounts from the foundation, 3 ways to win versus 1 or 2 for competitors. Infrastructure moat. Validator relationships and operational track record create competitive advantages that pure accumulation doesn't have. Institutional positioning. As Solana ETFs launched, they're positioned to capture that staking flow. Performance advantages. Solana's speed and cost advantages over Ethereum make it the better platform for high-throughput applications. Galaxy Digital's choice validates this. Recurring revenue. Even if SOL prices flatter down, they're earning fees. That's more sustainable than pure price bets. The Solana thesis. I believe Solana wins the high-throughput use cases. And if I'm right, Sol Strategies is perfectly positioned. But what should you do right now? Understand the validator business model. This isn't just about SOL price. It's about infrastructure services. Learn how staking as a service works. Research Solana's performance metrics. Compare transaction speeds, costs, and throughput versus Ethereum. Understand why Galaxy chose Solana. Monitor Solana ETF developments. When 3IQ's Canadian ETF launches and when US ETFs get approved, those are catalysts for Sol Strategies. Calculate the revenue streams. Model out staking yield on treasury, validator fees on client delegations, and the foundation discount advantage. See if the numbers make sense. Access operational risk. This is the most complex model. Can they maintain service quality as they scale? Can they keep winning institutional clients? Compare to alternatives. Could you just buy Sol directly? Could you stake it yourself? What's the value add of Sol Strategies versus direct exposure? Sol Strategies represents the evolution of treasury companies. It's not just about accumulating tokens. It's about building infrastructure, providing services, and creating recurring revenue streams. They're betting on Solana being the winning high-throughput blockchain. They're positioning as the institutional validator of choice. They're leveraging the Solana Foundation relationship for structural advantages. And they're doing this at a much smaller scale than Strategy or Bitmine, which means there's more room to grow. Whether this model works depends on Solana's adoption and Sol Strategies' operational execution. but the strategic logic is sound. Infrastructure revenue is more valuable than pure asset appreciation bets. In the next episode, we're going to dive into the risks of treasury companies, all the ways these models can blow up: dilution, debt, NAV, premium compression, regulatory challenges. Every investor needs to understand what can go wrong before putting money into these volatile beasts. I'm Douglas Borthwick. This is Old Men, New Money. If you found this helpful, share it with someone interested in Solana or treasury companies.